It's March the 12th, 2013. Michael Vaughn with Brian Acker. Brian, we missed the anniversary only by 4 days.
March 9th, 2009.
Oh.
I almost was on that ledge. I always remember that day. Yeah.
The S&P low.
The S&P low. I think it was 666.
Yeah.
And, so 4 years. It's been a hell of a ride in the last 4 years, but as you can see from our chart, our U.S. Select Value 50 fund, we're up 160%.
Yeah.
Just touching that. And the S&P, again, total rate of return for both, it's about 85%. So
it is a beautiful chart, and you are outperforming the index nicely.
yes, yeah. So
What does this mean that the market is working again for value investing?
it is. We're finally seeing. Look, first probably 3 years from '09, as stocks got cheaper, their risk actually went up because we were in a deflationary world. We were in a world where low stock prices represented risk. So a lot of investors shunned these lower price stocks, lower valuation stocks, and they went for consumer staples, more stable, maybe dividend type of companies, which really is not really our bag. And so when I look at a performance like this, if we get into a market that favors value investing, that favors capital going into companies that are cheap and potentially turning around, the performance would be quite a bit better actually than the last 4 years. So,
Well, value usually leads, 7 years out of 10?
absolutely, when you take a look at a 10-year period, value will trump other investment styles 7 of the 10 years. 1 or 2 would be growth. Obviously, maybe once every 10 years you get the momentum crowd finally winning. But yeah, 7 out of 10 years. But we've gone for a while without value really being on top. So we're going to have to see actually what the future holds. But if we get to a place where companies or investment managers are rewarded for taking a risk on low valuation equities. Now we've been seeing that over the last probably since September of last year. So we're getting into a more normal market that investors are getting rewarded for sticking out there.
But can you say that these assets are still cheap?
Yes, we can. Certainly we have work. As anyone who's been on our Facebook page, we actually see valuation. We see cheap valuation. The issue is if investors as a group view that as risk, they could go down further. So obviously, if you got a growing economy that even grows at 2 to 3%, then obviously it gives companies a base of growth to reorganize themselves in terms of management,
Right.
Reorganize themselves in terms of markets, in terms of their own markets and the selling of their product. Then, you can get the 100% gains in those individual stocks.
So do you think this is setting up then as a secular bull?
Absolutely. We're not only a fan on U.S. equities, but also a fan of the U.S. dollar. I believe we're only in the first inning of a bull market in U.S. dollar and the U.S. dollar assets. So I've written many blogs. The U.S. will become energy self-sufficient by 2020, which is amazing. Just in terms of dollars, U.S. dollars sold into the world just by energy alone, buying oil from the Middle East. Having those dollars invested at home in North America, because Americans include Canada and Mexico, obviously, as a source of oil. Having oil on this continent versus importing oil from the Middle East, that's a significant game changer in my estimation in terms of how the U.S. dollar is going to be looked at. A lot of what happens is momentum in terms of a currency, in terms of assets. So money all over the world, whether it's China money, whether it's money from Europe, when there's a start of a process of rates of return, money will flow into the U.S. big time, not only looking for rates of return, but you can make, in a bull market, you'll make obviously money on currency as well.
It'll be harder, though, to make money in Canada, it seems.
Yeah, Canada is very tough. We're up 4.4% in Canada. I think the only way you can make money is you find cheap commodity sectors. Now, a lot of those sectors have been down, especially the gold sector. There's no sign of a turn there, but obviously by just every month or every so often, every quarter, by upping that gold component, gold will have their day in the sun as oil companies such as Suncor. They've kind of not had a good year or so, maybe a year and a half, but that sets up for the cyclical nature of the commodity itself. So we'll never know when that turns around, but obviously that sector will have a good quarter, could have a good year anytime in the future. So, and also too for the Canadian dollar, we suspect as the U.S. dollar becomes the currency of choice, the Canadian dollar, if it sells down to 85 cents, that would be a good level. It'd be a great level for Ontario, for instance, in terms of our manufacturing and in terms of what this province can do. Maybe the power shifts from the west coast, Alberta, Saskatchewan, more of the commodities, more back to Ontario, which we've been a have-not province now for a number of years. But a devaluation certainly in the Canadian dollar would certainly do Ontario a lot of good. So.
Well, I love the looks of that U.S. chart especially. I'm glad that March the 9th, 2009 is far behind us, and I look forward to seeing you in April. Thanks for your time, Brian.